Good morning, students. A very beautiful morning, a day where today we are going to discuss some very interesting and some brainstorming concepts, provisions in the topic of other sources. Yesterday, we completed our entire topic on capital gains, all aspects completed. Now, we will be today delving in deep in the subject, or I'll say in the residuary head of other sources. If you remember yesterday's class, what we discussed in that class is the nature of this other sources head. So as you can see, we discussed that it is a misconception which many times people carry about other sources, and it is actually coming out of the law itself that it is a residuary head. No doubt, I'm not saying it is not a residuary head, but treating it as only, like many times in a joking way, I say, treating it as a dustbin is not correct. Because whatever is left over, whatever is not covered anywhere else, whatever is not required anywhere else, will fall under other sources. This mindset is wrong. Why? Because many times in this particular mindset, we make a very big mistake. The mistake is we may even declare a no income item as a taxable item under other sources. Because if we are of the understanding that anything which is not falling under any other head would fall under other sources, then what happens with this mindset? We miss the first step. And what is the very first step whenever you are deciding on the income and the taxability and the amount is first finding out whether whatever you have received passes the test of income. Only when something passes the test of income, then will come the second point as to which head. So, the first thing that you should keep in mind when you are dealing with other sources is, yes, I do agree it is a residuary head. It is that source which is not covered under the other four heads. But for that, first, it has to be an income. Any receipt is not taxable. It has to be first income. Now, this is the residuary part, which is given under 56(1). Then comes the specific part. Now, this is something interesting where other sources completely distinguish out itself from the other heads. How? When we talk about other heads, you know that there is something which will be taxed in that head because it has the nature characteristics of that head. For example, it is in the nature of rental income, so it will go to HP only. If it is in the nature of a capital gain and fitting in the charging section, it will go to capital gain only. However, other sources interestingly has no nature character of itself. As we know, it is the other sources, residuary head. So interestingly, you cannot have any characteristics as to, okay, if this type of income arises, that will come to other sources. No. So interestingly, if you remember, I had mentioned this point that this second part of other sources, which is 56(2), which I call as the specific receipts, where we started studying yesterday itself, that specific items are given as to what would be taxed under this head. Now, in this particular case, when you are reading this 56(2) list, yes, there are some regular items like interest, dividends, etc. But at the same time, the lawmakers have used this 56(2) to ensure that there are no tax evasions. So 56(2), which gives you the list of specific receipts, is basically aiming at ensuring that in case if any income is not getting classified under the first four heads because of the very specific nature of those heads, then it should not go untaxed. And for that, this head, other sources, will be helpful or will be used. One more point about other sources is, again, I had mentioned this sometime back in my class, that initially, when this act was created, you had 6 heads of income. First, as we all know, salary. Today, the second head is HP, third PGBP, fourth CG, and last other sources. But there was one more head, interest on securities. So originally there were 6 heads, and this today is blank. So if you see the Act, section 18 to 21 is blank. Why? Because earlier there was this head, that is income from other sources. Later on, they merged this with other sources, and hence this head is not in existence. So that is why a very common item like interest is also part of this other sources chapter or head, but importantly, it was earlier part of some other head. So with this brief background, let me now launch today's class. Happy Lohri, happy Makar Sankranti to all present, my dear students. And yes, very good morning, Dingar, Tisha, Rashmi, Dhanlakshmi, everyone. Very, very warm and a very knowledge-filled morning. So let me start. What is the format of other sources? The format is simple. Identify what are the receipts, and from that deduct what are the eligible deductions. Now, when I say eligible deductions, in eligible deductions, you need to understand two things. One, that there is a list of eligible expenses under 57, and then there is also a list of restricted deductions under 58. This ineligible list is very similar to the PGBP section 40 to 43B list, right? Where certain expenses, even though allowed as deduction because they were satisfying our 4 golden rules of PGBP, but because of the express restrictions or disallowances, they were not allowed as deduction. Same, I'll say, not even similar, same list is in section 58. So there will be no effort in understanding 58. All our efforts is only understanding the receipts, because there are certain specific conditions given to that, and the specific expenses or deductions. Now this list is mainly arising from 56(2), and in this list you will find many common incomes, but at the same time some very interesting incomes. Within common incomes, like we studied dividend yesterday, you find that even though the name is very common, but what is included in this is something very interesting or special. And let me tell you, students, you may not get a very specific practical question. Other sources will always be part of your computation of total income, that is the comprehensive sum. So, and anyways, there is no much working. Only you need to know how much deduction is allowed and where. But other sources will be very, very critical, this topic, in those questions where either there is some analytical part involved or in the MCQ type question. So you need to minutely understand each of these individual items, because one of these individual items would be covered in those comprehensive sums or the MCQ or the analytical type of question. Harsh is asking, sir, in capital gain illustration 10, patent purchase on 110, but they charge depreciation for full year. Oh, great. Rashmi has already answered. Thank you, Rashmi. So Harsh, as Rashmi has pointed out, that since we are following PGBP because that patent is part of your business and you are covering it under the PGBP head. So section 32, which deals with depreciation, and read with rule 5, which deals with the manner of computing, read with section 43.6, which deals with how to compute the WDV for the purpose of depreciation. Considering all these points, I'm sure you would recall, Harsh, that in income tax, we do not have proportionate day-wise or month-wise depreciation. We either have full or half. The cutoff date comes to 2nd of October because the rule is, as Rashmi pointed out, the 180-day rule. So if your asset is put to use for more than 180 days, and this will happen if the asset is put to use between 1st April to 2nd October, then the days would be 180 plus. And beyond that, if the asset is put to use, that is from 3rd October onwards up to 31st March, then it will be less than 180 days. That is where full and half will differ. Okay, coming back. So this is the list of items which are covered in other sources. Now here, some very important point is to be noted that when you are studying other sources, you will also have a list of those items which would fall under other sources if it is not falling under a particular head. Like here in this list, you see a list of those items which will fall under other sources if they are not falling under PGBP. So this type of item is there. This is the residuary part. But why this is mentioned? Because depending upon, now pay attention. Now somebody would like to know, okay, sir, how I will know that whether these items are PGBP or other sources? The answer is simple. If any of these incomes are earned with the intent of running a business, I'll give you example. See, take third case. What is covered over here? Letting out on hire. What? Machinery, plant, furniture, or same letting out on hire, same thing, machinery, plant, or furniture along with building, where building is inseparable. Now, giving anything on rent, correct? Letting out on hire means giving on rent. This may be your business. Now, if you are running the business where you give out things on rent, then the same item would be covered under PGBP. But if it is not your business, but you are having these items and somebody asked you for them, okay, I need your car. I want to go on for a trip with my family. And you say, okay, you can take it. I will charge you, let us say, 10,000 rupees as rent. So this is giving a machinery on hire. Similarly, you have some item, let us say you have a plant or equipment which is kept like a AC or something, and somebody asks you for that or furniture item and you give it on rent, which is a casual renting, I call it. No such term used in the law. Casual renting. Then if it is not your regular business, but it was lying with you, somebody asked for it, so you gave it. These all are examples of cases where it is not PGBP and hence it is other sources. Now coming to B, interest on securities. Importantly, what is to be noted is, now you all have studied accounts very well. In accounts, you will find there is something called as trade investments and non-trade investments. Trade, non-trade. Now, what are trade investments? Like you are a bank, you are an insurance company, and you are having a compulsion of buying certain securities. Like in case of bank, you have to maintain a particular ratio, SLR, when you need to compulsorily have some amount in liquidity, some amount in some type of securities. Now, when you have bought those shares, debentures, bonds, which is a compulsion requirement, so that you can run your business, such investments are called as trade. Now, whatever interest arises on such securities or investment will go to PGBP. But where you have purchased any of these securities out of surplus funds, may be arising from business only, but those are surplus funds and there is no compulsion that if you want to do a particular business, you need to maintain these securities. There is no such compulsion. You have done it out of your choice. Then it becomes non-trade. Then it comes to other sources. But interestingly, now see here, many times people get confused that whether the same rule applies to dividend income. Answer is no. Had this been the case, dividends would have fallen in this list. But dividends are kept independently. Means even though you are in the business of trading of shares, please understand, you are in the business of trading of shares. In that case also, if you are getting dividends, it will always be other sources. See, this is what I was mentioning at the start. Certain incomes as per 56(2) are going to specifically be covered under this head. So this also you need to remember that it is not that there is any connection with business, so it will always go to PGBP only. If that item is specifically covered over here in 56(2) without any condition like this, what? That if it is not covered in that head, then covered under this head. If no such condition is given, it will be covered in other sources only. Similarly, look at this item, Keyman Insurance. I'm sure you remember my earlier discussion during the PGBP head that Keyman Insurance policy amount, if received by employee, will go to his salary income. If received by the employer on the death of employee, employer receives the amount, it will go to the PGBP head. But if it is received by the director or if it is received by the family members of the employee, in both these cases, it will be taxed under other sources, and the same thing is given that the sum which is received under Keyman policy, if it is not chargeable. Now here they have mentioned two heads. Already we are seeing the list of incomes which is not falling under PGBP. Here they have said salary head also. So this is how some incomes fall under other sources, but subject to not being covered under other specific head, mainly PGBP, and in one case even salaries. And the last point is the residuary point. So this is the list which we have started discussing. We have covered the first one in the previous class because it was a lengthy one. We covered what is dividends in section 222. Then we covered what are the deductions for dividend income and tax rate, which is anyways normal tax rate. There is nothing special in that, right? This list of allowable deductions we are studying along with the receipt, so that when you are preparing for exams, it is clear. So I'm not going section wise, I'm going receipt wise. So we study a receipt and we come to its specific deduction. Like yesterday, along with dividends, we studied this, where if you are receiving dividends, what is the rule? Only one expenditure is allowed. That also against the dividend between A to D. Sorry, A to E. What is that one expense which is allowed? The interest expense, and that also up to 20%. And for the new dividend which is covered in F, which is the amount received against buyback of shares, for that there is no deduction allowed at all. And then these remaining we study as we go to the respective item of income or receipt. This 58 list also I briefly touched yesterday. If you see the list, it is copy paste of section 40 to 43B that we studied in PGBP, where these 1, 2, 3, these three items are relating to non-deduction or non-deposit of TDS as we studied. Okay. So first, these three clauses B, C, D are covering the same points which we studied in PGBP. And in this, if you remember, where the payment is outside India, 100% will be disallowed. And if it is within India, then only 30% is disallowed. So same copy paste point. Then So this is parallel to 40 clause A provisions. This is 40A2 provisions where payment is made to some specified person or related person. Then only the excess amount, which is over and above FMV, will be disallowed. And then this is the 40A3, where it says where the payment exceeds 10,000 in a day to a person, then it will be allowed only if paid by account pay check, account pay draft, or any of the banking channels or online medium. If it is paid in cash, bearer check, or even cross check, but not account pay, it will be fully disallowed. Copy paste points, whatever exceptions were there, that for freight charges instead of 10,000, it is 35,000. Then Rule 6DD, where for certain payments like payment of indirect taxes to government, payment on a bank holiday, payment for natural produce, all those things continue here, right? So see, try to equate what is similar so that it will be easy, right? Harsh is asking for intangibles. See, beta, Harsh, when you are studying PGBP depreciation, there is no distinction between whether it is tangible and intangible. Yes, blocks are different, but the method of calculating depreciation, the format 43.6, which gives you the format of WDV and read with Rule 5, it remains same. What is GTI, Nagaraja beta? Okay. Now, this is about the tax rate. In this, we studied yesterday the tax rate for dividends because we covered dividends. Dividends is falling in others. So there are three incomes, rather I'll say not three, even two only, because both these are winnings only. But this online gaming was added in 2022 only. So that is why it is showed separate. So for winnings, the rate is 30% without any deduction. And for this, which is a very important point, which we are going to discuss in detail, the rate is 60% plus 25% surcharge plus 4% education cess, which makes effectively the rate as 78%. Why? Because it is the tax evasion cases. We'll discuss this in detail. Right? Now, method of accounting, same like PGBP. Section 145 deals with two heads, PGBP, other sources. For both heads, what does 145 says? That only for these two heads, you have a choice. How you maintain your books. If it is cash basis, we compute income cash basis. If it is mercantile basis, we compute income mercantile basis. Further importantly, within that, if for different businesses and for different sources of other sources income, if you are having different methods, it is also allowed. So for a few sources of income falling under other sources, you cash basis, we compute cash basis. You follow accrual basis, we follow accrual basis. So it is not that for entire head also you should have the same option. Further, there are few exceptions where the income will not have option. You have to tax it only on receipt basis, that we will see as and when it comes, right? Nagaraja beta, why you are getting into so much of technical detail, GTA, GTI? Effectively, it is same. Firstly, I don't know what is GTI. I don't know what you are referring to as GTI. Navneet, what is 78 beta? What is 78 Navneet? Yeah, 78%, correct. Fine. Now, first specific income covered under other sources is dividends. Interestingly, if you do not read this definition or till the time you read this definition, you always knew dividend only of one form. That is how you receive dividend in monetary form, where nowadays it is getting credited directly to your bank. I have seen those eras where we used to get checks, and even those eras where people used to collect it many times even in cash. So Dividends in money form is only the dividends that we were knowing. And I yesterday simply put it in simple words. What is dividend? It is the amount paid by the company to the shareholders as a share in profit. So whatever profit company has earned, ultimately the owners are shareholders. So company is giving away everyone a share in the profits. But when you come to income tax section 222, you realize that income tax is looking at dividend from a different perspective. But it is not different. See, money dividends are always dividends and we need not define it. What we are trying to define it is that where income tax law felt or rather has records that people were evading tax by trying to give dividends in a different manner to bring it out of the normal dividend concept so that it should not appear as a dividend. That is where the law brought this definition, and they have said that all these different mechanisms of giving payment to your shareholder will be deemed as dividends. Obviously, with the most important condition which is flowing in all these points is only if the company possesses accumulated profits. If the company is not having accumulated profits, then none of these forms will be treated as dividends. What is the first form? Company is giving dividends by not giving money but distributing assets. So company has given you its car, or let us say, which from where this has come. There was a period where company started giving gold coins, bullions, and it said that, and I'm talking about 70s and 80s, where the concept of gift and all, which is today taxable under the other sources, was not there. Other sources gift came into existence for the first time in the year 2006. Maybe many of you all would not even be born at that time. So firstly, in the Act, the taxation of gift, which we are going to study in this chapter only, came in the year 2006. It was amended in 2007. Then it was expanded in 2010. And then slowly, steadily, we have the present section on gift. But I'm talking about that period where there was no tax on gift. So some people used their brains of finding out a loophole in the law, that they said that let us not give dividends in its regular form, like giving in the form of money. Let us give it like a gift. So what the company did, either it gave away any of its assets. Obviously, this used to happen in the closely held companies where the owners are themselves running the company because they are also the directors. So that is where the company decided to give or distribute their accumulated profits in the form of assets. So clause A covers that. Then clause B is where they said that, okay, let us distribute our debentures, bonds to our shareholders. So this will become an additional investment for them. They can hold it. Or if they want money, they can sell it in the market and they can get money immediately. So that was the second way. Third was, and third and fourth are specific scenarios. Third is where the company is under liquidation. Now, important to be noted, this third and fourth may not have arisen because of tax evasion scenario only. It has arisen more like a clarification that at the time of liquidation, what a shareholder will get from the company is amount not only towards his capital, but also towards the reserves. This is what again we have seen in accounts. See, many times I say that if you want to understand income tax and GST, conceptually, you should be also looking at the accounting part. It is not that accounting will decide taxation, but when you are doing something in accounts, it gives you an idea or it gives you the clarity about the true nature of that transaction. And once you understand the nature, understanding taxation will be much easier. So if you recall this, which you would have done in accounts in different topics of accounts like amalgamation or liquidation of companies, then you'll find that when a company is getting closed, what it will do, it will transfer these amounts to a shareholder's account, which is the capital amount and all the accumulated amounts. So keeping this in mind, when you read clause C, the clarity is there that At the time of liquidation, the company is going to give you out of two things. One is out of the capital, or I should change the word, towards the capital. And second thing, towards the reserves. So whatever is towards the reserves that the company is giving you will be deemed to be your dividend. Correct? Then comes D part, again, may not be a tax evasion scenario, but again a clarificatory point that whenever during the life of the company, wherever the company law has allowed the company to reduce its capital, whereby the company does what? It takes back its own shares, or it part pays its shares. So where the shares are of 100 rupees fully paid, it will pay some part and make it partly paid. So this is how sorry. So this is how the company does reduction of its capital. Whenever the company is reducing its capital, same point like liquidation will happen. I will not only take the money towards the capital, which the company is reducing. I'll say that give me even proportionate reserves, because on the basis of the capital which I contributed, you have created so much of accumulated profits. Now, in this regard, what is important to be noted is that in this regard, again, the law says to the extent the company has accumulated profits, whatever is given out of these accumulated profits at the time of reduction will be treated as your dividends. Now coming to some things very special, clause E, and then later on the latest clause F. Clause E has come purely as a result of a tax evasion scenario where private companies found a new mechanism to evade tax. See, if they give assets, they fall in clause A. If they give away their liabilities, they fall in clause B. So they decided, let me find out a new mechanism. What was that new mechanism? That these closely held companies, which is in simple words, private companies, started giving loans or advances to their major shareholder. Who is a major shareholder? Who holds 10% or more of your equity shares beneficially. So such major shareholders decided that they will withdraw their share in the profits, which is the dividends. How? By showing it as a loan. So they used to take a loan from the company. Now, importantly, interestingly, this loan would never be paid off by the company. And at the time of liquidation, it used to get knock off against the balance. This is how the practice developed. So the law brought in the clause E, which said that wherever loans advances are given by a private company to its major shareholders, again, to the extent the company possesses accumulated profits, we will treat it as your deemed dividends. Now, some important points. Not only loan given to the shareholder, but even given to any of the businesses in which the shareholder has a substantial interest. So it may be a different entity, HUF, partnership firm, LLP, AOP, BOI, or a company in which the shareholder has 20% or more of the share. In such cases, the advances or loans given to them, again to the extent of accumulated profits, will also be treated as deemed dividends. However, in some cases, there may not be deemed dividends. One, where the company is in the business of giving loans, like banks or NBFCs, then if it gives loans to its major shareholder, it will not be treated as deemed dividend. Second, where in future the company has given actual dividends, that is, which is in the money form, then this deemed dividends, which was earlier given as loan, will be knocked off, will be subtracted, and in that future year, only the difference would be taxed. Now, for this deemed dividends, it is also clarified that this deemed dividend rule is applicable irrespective of whether or not you are going to repay back the loan. So let us say I took loan in this year and after 2 years I repaid back. So this year it was treated as income under 222E. Then whether it will be reversed after 2 years, answer is no. This will remain as your deemed dividend. It will not change. Again, even if the company is going to charge you interest at market rates, all these things will make no difference. Once a private company gives loans advances to its major shareholder, even if it is reversed in the same year, still it will be attracting this provision. That is how the law is very strictly crafted. And then comes the latest clause F, which deals with the scenario of buyback of shares. Now, when it comes to buyback, what is important to be seen is that there were different provisions before this. So sometimes back, the provision was that the company itself will pay tax on the buyback. Then the provision was that the buyback would be taxed as capital gains in the hands of the shareholder. But last year, all this was amended, and the position today is that if you are having any shares of a company, and whenever the company buybacks these shares, this buyback will be treated as your other sources income. Now, what is very important to be noted is you would have purchased these shares for some cost. Even though you have purchased these shares for some cost, this will not be subtracted. So what is the tax treatment? In this example, you are having 40 share, how many shares? 100 shares of this company, which were purchased at rupees 40. Company bought back its shares by paying you at the rate of 60. So there are two tax treatment. Whatever payment the company made at the rate of 60, this entire amount is deemed as dividend and it is fully taxable without any deduction under this head other sources. And whatever was your cost of acquisition will now be treated as a capital loss. Now, depending upon the period of holding, it may be long term, it may be short term. If you remember, this point was covered even in our capital gain chapter. So this is what is the present position in law. Is this clear? Section 8, how or when the dividends are taxed. So for this, they have classified the dividends into 4 categories. So first is your regular dividend, that is the dividends which is given for the whole year, and this is generally declared after the end of the year when the company is finalizing the books and in the AGM. Such dividends are taxed on accrual basis, that is the year in which it is declared, because many times the company declares in a month but it is paid after 2, 3, 4 months. That makes no difference. Regular dividends are taxed on the basis of its declaration, whereas interim dividends which are given in middle of the year, will be taxed only on receipt basis. The language uses made unconditionally made available, so it means receipt basis. When it comes to deemed dividends, clause A to D, these 4 deemed dividends are taxed in the year when that asset or that debentures or anything was distributed. E, that is the loan, is again taxed on receipt basis, that is the year in which the company gave you the loan. And the latest one, that is F, the company bought back its own shares. So this is how the timeline of taxation of dividend will happen. And what is the tax rate? It is taxed at normal rate. There is no special rate for dividends. Yes, I'll come to the chat box. Yes, Navneet, पूरा purchase cost capital loss बन जाएगा. Correct. So students, I hope everything till this point is very clear to everyone. Anybody having any doubts or questions, please let me know. Chalo, let us have some discussion just to break the monotony, because for around 40 minutes I have been speaking and today much of it is theory. So let us have some discussion. Maybe any question, doubt you have, any topic or any other issue you want to discuss. Chalo, just 2 minutes, 5 minutes, just to break this monotony. And even I'm starting the next part, so I want you all to be slightly lighter. Chalo, tell me. come up with anything. You can share any of your experiences of studying, any plus minus you are having in studying. Tell me, please. Chalo, students, you may, if you want, you raise your hand, I'll unmute you. See, Harsh, 180 days criteria is applicable for all heads. Don't understand it like this. Keep it in mind like this. Wherever you are going to compute depreciation by the block method. Now, I understood why you are asking this question, because your point is that we studied this 180 days only when we were studying PGBP. Now, when we went to capital gains, there also capital assets are involved. It may be sold. We come to other sources. Here also, maybe there is some reference of any capital asset which may be covered here. So the question that you are raising is whether for all these capital assets, we have to apply 180 days criteria or only when we are in PGBP. I'll answer this. See, your income from that asset may be covered, income or expense, whatever, may be covered in PGBP, in capital gains, or even in other sources. But whenever you are going to compute WDV for that asset by the block method, that WDV may be used in PGBP for its workings of depreciation, may be used in capital gains for its working of capital gain, or may be used in other sources for its working to treat that particular item as income in other sources. So wherever you have to take WDV and it is of the asset which is covered under block method, you have to follow the same rule which you studied in that chapter, and hence answering your question, 180 days will apply. So 180 days has nothing to do with heads. It is concerned with the computation by the block method. Fine, beta. Rashmi, what did you not understand? You said interest on securities you did not understand. So what in interest on securities you did not understand? See, what are securities? Share, debenture, bonds, all these are securities. Now, when you'll get interest where you have purchased debentures or bonds of some company, the company will be paying you interest. That is what is interest on securities. Now, in this, where you have a confusion, tell me. Can you upload? Yes, beta, Hiram, that will be uploaded. I have not uploaded for a reason that I'll discuss. Lingar is saying in case of cooperative society, it is dividend given to members are whether charged. Obviously, see why it will make a difference for cooperative societies. Dividends are dividends. But yes, when we talk about these deemed dividends, where they are specifically covered only for companies, those deemed dividends concept will not come in cooperative societies. Anyways, please understand, Lingar, cooperative societies give you only one share. It is not that you buy 10, 100, 500,000 shares like how we do for companies. So for cooperative societies, the deemed dividend concept is not covering them. Why? Because you have a one share. That is only the requirement. In fact, cooperative societies have that type of a rule that you can only be shareholder of only one share. So how much tax evasion you will do with one share? Correct. So that is why whatever we studied relating to deemed dividends, like you are saying, loans given are treated as deemed dividend, that will not apply to cooperative society because cooperative society will not have tax evasion. Means the possibility is not there. Why? Because everybody is having only one share. Yes, students. Anybody else having a query, doubt? Okay, Dhanlakshmi has raised her comment. I'm unmuting. Yes, you are unmuted, Bill.
Good morning, sir.
Very good morning, Bill.
Sir, under capital gain, um, when we under section 54B, sir, when we transfer agricultural land of urban, urban agricultural land,
Hmm.
and then I purchase a rural agricultural land.
Hmm. Hmm.
I get a exemption also.
Correct.
I get an exemption, but if I sell a rural agricultural land within
Hmm.
3 years, then
Hmm.
I cannot like we have to minus the exemption in cost of acquisition.
Correct, beta.
But for this, we will not able to minus, no, sir.
In fact, it is a benefit, na? Because
Yes,
when you are selling a rural agriculture land, there is no tax on rural agriculture land
yes,
sale because it is not a capital asset in the first place. Correct.
yes, yes,
So indirectly, the reversal, which was supposed to be done because you are selling the new agriculture land within the lock-in period, will also not happen. Are you getting the point? So what you are saying, I'm just adding to that. You will not subtract the cost of acquisition. Why? Because there is no taxability on the sale of rural agriculture land. So whenever you will sell this new capital asset, which is the rural agriculture land, the old exemption which you got need not be taxed again. Because what is the method of taxing? As I explained yesterday, the method of taxing the old exemption is by subtracting it from the cost of acquisition of the new asset,
yes,
but that you do only if the new asset is taxable. So in
yes,
fact, at finals, you'll study that this is a tax planning measure. See, at finals, when you read this subject again, the same topics would be dealt with from a different perspective. Today, you are understanding this from the working perspective. If you see your module first part, preface, it says here you need to have working knowledge. When you read the preface of your CA final modules, it will say you need to have expertise knowledge. So over there, we study the same provisions from the perspective of tax planning, from the perspective of if there are any ifs and buts in the provisions, or if there is any conflict or contradictory point, right?
okay,
Yes.
okay, sir. Thank you.
Okay. Now taking this point, let me discuss on one point. Yesterday we were having discussion of that 36 months rule for slum sale. As I just said, that there are many times certain provisions which are self-conflicting. So yesterday somebody said that, sir, the Google is saying 36 months. Why the Google is saying? If you read section 50B, which deals with slum sale, somehow the lawmakers, when they amended capital gains, see, earlier capital gains had this rule of 36 months. So very originally, capital gain had only one rule, 36 months. That assets more than 36 months are long term, less than 36 months are short term. Then some 10, 12 years back, they brought in one more rule that was for securities. They made 12 months. So we had two rules, 12 months, 36 months. Then some 5, 6 years back, they brought in the 24 months rule, which was applicable only to land building. So we had three rules. For securities, it was 12 months, not all securities, some certain securities 12 months. For land building, 24 months, and for all other assets, 36 months. And then just last year, they amended all this. Last year, there were major amendments in capital gain. And now you have only two rules. One is 12 months rule, one is 24 months rule. If you see the period of holding and the definition of short term, long term, you will find only two rules, 12 months, 24 months. Now, what we were just discussing about, at final level, you analyze things critically. Now, interestingly, why our module is still having 36 months? Our module is correct, it is not incorrect, because it is the incorrection maybe at the side of the lawmakers. So last year in 2024, when they made amendments in capital gain, and they made now only two rules for long term. One is the 12 months rule for securities and the 24 months rule for all other assets. This they made amendment in the definition of short-term capital asset, but they forgot that section 50B, which deals with slum sale, has a specific reference in its proviso saying that if the business is more than 36 months old, it will be treated as long term, or if it is less than 36 months old, then it will be treated as short term. They missed to amend this provision in 50B. So, see, at BOS or at our interest level, we try to simply reciprocate the act as it is. We do not go into that particular technical part or analytical part, whether there is some mistake in the law or not. That is what is at final level, what I was just explaining. So even today, it is 36 months written in the proviso of 50B. But in the main part where short-term, long-term is defined, over there, the law is amended. So there is a self-conflict in the law. Now, yesterday, since we had such a long discussion, I thought I'll check with BOS so that I can inform you what is to be done in exams. So I confirmed with BOS. They said, "Hey, sir, at inter level, let them have 36 months rule only because the law is yet to be corrected." Yes, it may happen that after 15, 16 days, that is on 1st of Feb, when you'll have the budget, if they correct the law in that 50B, then again, the second question will come to you all, sir, whether for our exams we should follow the correction or not. That will be issued by the ICAI BOS. But till then, what I got confirmation yesterday, that since 50B proviso is still using the old provision, which obviously is an anomaly, but at inter level, since we are not going by the in-depth analysis, whether there is some anomaly, there is some correction, we will follow the 36 months rule. So you can say academic purposes, you will follow 36 months for your slum sale at CA interlevel. So I would request everyone to please make a note of this, that at interlevel, you will keep 36 months for the time being for the slum sale part. If it gets amended in this budget, amended means not amended, I should use the word corrected, then again, we will come back with the advisory that whether you have to apply the corrected rule or you should continue this 36 months rule. Yes, Navneet. So, but we have to consider 36 because there is an anomaly, or I should use the word mistake in the law. They forgot to amend that part because see, it happened just last year. So now the next attempt will be now that maybe if they correct it in this budget, you may have the new 24 or the correct 24 months rule. But till then, I confirmed it yesterday from viewers that at interlevel, we will be following the law as written. So even if there is an anomaly, for our academic purposes, we will keep 36 months rule in mind. So I request everyone to please make a note of this. So for slum sale, for the time being, you will keep the 36 months rule in mind, right? Mithili. Yes, ma'am.
Uh, Sir, one general doubt. I
Firstly, how
was
do you
registered
pronounce your name? Is it Mithili?
Maithili.
Maithili. Okay,
Maithili.
tell Maithili.
Sir, one general doubt is not related to subject related income from other sources.
No
It is
problem. Tell me.
I was registered inter on 2024 Feb, and I have that material only income tax. And here after December 25, GST rules are amended, right? That's why study material is changed or same material only, sir.
No, but a study material will change. So what you
Will
should
not
do is,
change.
I'll
Any
tell you something.
amendment or added to that study material, sir?
Yes, beta, that is what I'm saying. Don't worry, don't
Okay.
panic. Our BOS portal uploads all the latest material. Plus, we also upload the statutory updates, which is applicable to a particular exam. Now, see, when you have come in this profession of chartered accountancy, now you'll have to keep yourself adapted for this, that you are studying a particular law at a particular point of time, but maybe when you're actually giving your exams, you have to apply the law with the amendments. Now, what amendments are applicable to your exams? At BOS, we come up with us with something called as statutory updates. So I will request that even if you have old module, keep it aside, go to the BOS portal. Over there, you have the new modules uploaded, which you can download. Plus, nearing your exams, whenever your exams will be there, maybe in June or in September, whenever in January, whenever it comes, just 2 months before the exams or 3 months before the exam, we also upload something called as statutory updates. Like if you go to the BOS portal now, you will find statutory updates applicable for the previous exam, which I think just happened January or which is going on. So you will get those statutory updates saying that, okay, this is the module uploaded on our portal and these are some amendments or these are the updates about what amendments are applicable. So you have to simply better download that module. As far as GST is concerned, I will say that download the module, take a printout if you are comfortable studying with the physical module. As far as income tax is concerned, I'll say you just download it. If you have a physical module of income tax, just make the amendments by your hand at the respective places. If you feel that will be burdensome, then even take a printout of that. It is as simple as that, Maithili.
Yes, sir. Yes, sir. If GST amendment are newly commenced, this change will be affected only GST, right? It
No,
will
beta.
not affect a taxable module.
Why not, beta? It will affect the entire tax module, no? Because if income tax has amendment, like today, in next 16 days, you'll have the budget. So budget will
Okay.
have amendments for income tax also, right?
Yes, sir.
But those amendments may not be applicable to your exam. So see, there are two things. One is amendment and one is applicability of those amendments to exams. That is what we
Yes.
inform by way of the statutory updates. So what I will simply suggest is right now you download the current module which is hosted on our BOS portal and use that module. We are also using the same module, beta.
Yes, sir.
Fine.
And also, I have one fear about exams. I till now I'm not attempt any exams in for one group or two groups. Hereafter only I need to attend the exams. That's why I'm fear about this December 25 GST regulations or change. That's why, sir.
Okay. See, Maithili, this good point you raised. See, for every one of us, including me, when I joined CA course, somehow people around us always say CA is very difficult, you will not be able to pass, or CA is not your cup of tea, or only very scholarly people pass. All these things were told to me. But let me tell you, my dear student, Maithili, and everyone, that CA requires only one thing, that is focused studies. I have taught for last around now 26 years I have been teaching. Plus I myself studied. I can tell you from my personal experience, personal experiences of my many friends who studied along with me and thousands of students to whom I have taught till date. I have seen so many cases where the students were average in school with 50-60 percentage. Even I don't feel ashamed in saying that I myself was never a scholarly student in the school. My highest score till date in any academic exams is 74%. But still, I scored very well in the CA final in the taxation paper. I scored very well at inter level in the audit and the costing paper. So the point is, it is immaterial. What is your uh, maybe academic scores? It is immaterial in our CA course how scholarly you are. I have in fact seen the other side also. I have seen students who were board toppers at 10th or 12th, but they failed in CA exam. But again, it is not because CA by itself is difficult or cannot pass, etc., etc. It is because CA requires a specific approach which somehow we fail to adopt. You need to
Yes, sir.
have an in-depth knowledge of the subject, point number one. And second most important point, you have to regularly, dedicatedly study. You cannot
Yes, sir.
study like how you study in college or even in schools, that you only prepare when the exam comes. So if your exams are in December, today we are in January, you have more than 10, 11 months, beta. I guarantee you will pass this December if you continue your studies on regular basis. I'm not
Yes,
saying
sir. Sure.
don't take break, don't enjoy, don't attend family functions. No, that is equally important. I repeat,
Understood, sir.
that is equally
Yes,
important.
sir.
Attend family functions because it rejuvenates you. Go out with your friends. That is equally important to keep you mentally fresh, psychologically balanced. Do your hobbies, whatever they are, but do it in a disciplined manner. Allocate suitable, sufficient time for studies and do it regularly. See, the best part for you all is add BOS we keep on repeating the subjects because we have this batch, which is, let us say, for June attempt. You'll have another batch for September attempt. You'll have again another batch for Jan attempt. Or where there are no specific batches, you have the revisionary classes. And as our student, you can attend all of them. We don't restrict that, okay, you can attend only one batch. You can repeat second time, third time. Do that. Because of that repetition, what will happen? See, let us say for a student like me, I may not understand things at the first go. But when I attend it for the second time, it is much, much better understanding. Maybe when I attend it for the third time, things get permanently fixed in my head because I require 3 iterations minimum. Maybe somebody else may require only one class to understand, but that is okay. People are different, mindsets are different. So I can guarantee, beta, guarantee you will pass
Yes, sir.
by December itself with only one rider. Have focused, disciplined studies.
Yes, sir. Thank
Fine.
you, sir.
And be in
Yes.
touch with us through all our various batches, to all our BOS material. Just use that, what is hosted on the website, the
Yes, sir.
module, the updates, the MCQs, MTPs, RTPs. Even if you do that thoroughly, you will pass with it. Fine.
Yes, sir. Yes, sir.
Okay. Now, the second specific income, which is covered in other sources, but please mute yourself. Maithili,
Yes, sir. Yes, sir.
please mute yourself. Okay. So the second source, if you see the act, is named as casual income. Now, exactly what is casual income? Casual means which is not having any fixed pattern. Casual means something which just happens. Now, what is opposite to casual? All other heads of income like salary, which happens regularly, business, which happens regularly. Okay, you may incur a loss in business, but your business is going on a regular basis. Dividends, interest, all these are regular sources. Then what is casual? Casual means something which just happens out of the blue, which is also called as winnings. So what is covered in casual incomes here is where you get anything from lotteries or betting or gambling or now today the online gaming or by participating in these crossword puzzles. Many times you have this in newspaper, you fill in, you send it, and you get some 100, 200, 500 rupees. Or people put their bet on various races or they put their bet in card games. If you earn any amount of this, that is what is casual incomes, or that is what is called as winnings. Why? Because we always say in Hindi, "Main ye jeet gaya." So it is winnings only. Most important thing is this is taxable gross. Gross means like what is our format? You have to subtract expenses. There is no deduction allowed from any of these casual amounts. The gross amount is tax. Only when we will go to online gaming, there is a slight different rule, but over there also this rule continues that expenses cannot be deducted. So all these winnings are taxed gross. Gross means without allowing any deduction. Plus they have a specific special tax rate which we saw earlier of 30% flat without any benefit of rebate relief, etc. Now you come to this third part. Then you come to fourth part. Both these have connection with capital gains chapter. In your capital gains chapter, towards the end, when we were discussing the various scenarios, we had discussed a scenario of compulsory acquisition. And what was the example I had given over there? So you have a piece of land and the government wants to set up the bullet train track. So your land is there on that particular route. So government under the powers of the Land Acquisition Act gives you a notice that you have to vacate this land because we are going to now take over this land. This is what is called as compulsory acquisition, where your choice, your wish is not seen. It is that I have given you order, you have to vacate, and I will be taking over that particular land. Now, this is what is compulsory acquisition. Now, in case of compulsory acquisition, the rule of law is that whenever you have a capital asset which is compulsorily acquired and it is not covered under that 1037 exemption, then whatever you receive as compensation against that compulsory acquisition of asset, that is part of the capital gain head. So that is no doubt. Now what we studied over there, it may happen that whatever compensation was initially promised, you may receive it later. Second possibility, you have also filed against the amount of compensation a case in the High Court, and the High Court enhances the compensation. If you remember, we had done sums on this. So originally what was given to you as 5 crores becomes 7.2 crores. So there is some enhancement, there is some increment. What is important is the original compensation and the increment 2.2 crores. Both these amounts will be taxed under capital gain only. It has no connection with other sources. Then what is covered over here in other sources? If you receive this compensation late, let us say after 4.5 years, you receive this 2.2 CR after 7 or 8 years because of this case. So whenever you are receiving this compensation after some period of time, then again, the government has to pay you interest. So we are not going to tax the compensation amount, the original or the enhanced under this. It is going to go to the capital gains chapter, which we already studied. What is taxed over here is only the interest component. Again, the second important point to be noted is that this will be taxed on receipt basis. So this is the exception to 145, which has given option to you. At that point itself, I said that you will have few incomes which will not give you option, but these will be taxed only in the year of receipt. This is the first one. Now, if you remember, even in the topic of capital gains, when we studied this compulsory acquisition, over there, we studied the same thing, that this compensation or enhanced compensation, which is taxed under capital gain, that is also taxed in the year of receipt. So whenever you receive this compensation, and obviously the interest, because whenever it will be paid to you, since it is getting paid late, you will also be given interest. Both things will get taxed together. The compensation part will get taxed in the head capital gain, and the interest part will get taxed under the head other sources, and both will be taxed in the year of the receipt. This is what is provided as an exception in 145B. So 145(1) gives you the option, and 145B gives you the exception, where irrespective of the method of accounting followed, it will be taxed only in the year of receipt. Now, importantly, for this interest income, there is a specific deduction. Now, what is that deduction? Under section 57. Now, deduction is covered separately. I'll do one thing instead of going below, because that is in the very later part of this chapter. I'll go to the summary part. Yes, here it will be easy to check. So what is the special deduction? That for this interest, which is received for the compensation or enhanced compensation, you are given a flat 50% deduction. So what is important here is that this interest, which is taxed here, you are allowed flat 50% of this interest as deduction. So how much will go to other sources? The balance 50% will go to other sources. So whenever you receive this compensation plus interest, you will tax the compensation under capital gain head by that format of capital gain, and the interest will come to other sources. But in other sources, you will get a flat deduction, a lump sum deduction, a standard deduction of 50%. Again, this part was part of capital gains. If you remember, this was also studied in the later part of capital gains, that where you have received any advance. So I have a capital asset, my building. I'm trying to sell it to Harsh. At the time when this negotiation happened, we fixed up a price that I will sell it for 2 crores to Harsh, but he demanded or he requested for 6 months time. I said, okay, I'll wait for 6 months, pay me 25 lakhs as token or advance. This was paid by Harsh, but later on, for some reason, Harsh could not complete the deal and I forfeited this advance. Now, if you remember, we studied a date in that chapter, which was 1st April 2014. Now, what is the tax treatment? If the advance is forfeited before this date, you will subtract this advance forfeited from the cost of acquisition itself, and this will become your new cost of acquisition. That is, there is no connection with other sources chapter. But if this advance is forfeited on 1st April 14 or thereafter, then your cost of acquisition will not change. It will remain the same. That is your original cost of acquisition. And this will come under income from other sources. That is this advance forfeited. Keep in mind, this is a capital receipt, but this will be taxed under the head of other sources because of this specific entry, specific inclusion. Now I take up some questions. So Kambira is saying, if the capital gain assets are not fully invested in the new asset before the ITR filing deadline, what will happen? Beta, we discussed this yesterday itself, that up to ITR filing, you need to invest either in the capital asset or you need to deposit the amount in a special bank account open called as the capital gain deposit account. If you do any of these things before ITR filing, you get the deduction. If you fail to do, you'll get no deduction, even if later on you purchase a new asset, you will not get deduction. Navneet saying enhanced compensation will be taxed under capital gain and interest on that will be in it. Yes, correct. Right, Navneet, this is what we have discussed. Fine. Now, this is about the point relating to gift. I'll just come to this after the break. Let me take a smaller point because this will require fresh mind. So I'm just skipping it for some time till the time we go for break. Let me take up some smaller points. So I'm just skipping this. You can see the length of this and the importance of this. Now, this has connection with salary topic and even PGBP topic. If you remember, salary and PGBP also covers compensation. What is the difference? If you are receiving any compensation for loss of business, it goes under the head PGBP as per section 28, clause 2. But what is covered over here is something which has some more connection with salary chapter. Now, what is this? Let me first explain you what was covered in salary chapter. So if you are given compensation for loss of your employment, right, that goes to salary chapter. Now, there are two examples of this. One is VRS and the other is VRS and the other is the retrenchment compensation. Now, both these compensations, if you receive for the loss of your employment, it goes to your salary chapter. Now, what is very interesting is this compensation is also having a connection with your employment. Interesting. I just explained that if you're receiving compensation for loss of employment, it goes to salary chapter. Now, this compensation is also having connection with your loss of employment, but it is saying it shall be chargeable under other sources head. Now, what is the difference? How come compensation for loss of employment be taxed under other sources? The answer is this compensation, which is for employment, is taxed under two heads. If this compensation is paid by your employer, it is taxed under the head salary. But if it is paid by any other person, then it will be taxed under other sources head. See, so here they have written received by any person. So I'll say other than employer. So if your employer is paying you compensation for termination of your employment, which is like VRS or retrenchment, it is salary. But if any other person is paying, it is other sources. Now you'll have a question. See, we should not only read the provision, we should try to link it with our practical life so that it gets absorbed. So practically the question will be, sir, in which case any other person will pay to me for leaving my job? See, today we say it is cutthroat competition. The world has become very commercial. The world has become very shrewd when it comes to business. So let us say you are a very important employee for your employer. Your employer or your employer's business is my competition. Now, in this particular case, if I want to, let us say, affect your employer's business, who is my competition, what I will do is I will ask you to join me. Now, many times today, there are salary contracts which puts this condition that if you are employed with X company in a particular line of business, you will not, after leaving the job, join the same line of business for next 5 years, 10 years, whatever. Such restrictive clauses are allowed. So you say, sir, sorry, I cannot join you. Then I said, no problem. Do one thing. You just leave that person's job. Why? Because you are so important in that business that if you leave, that itself will affect his business. In such a case, I am today not your employer, neither I am going to be your future employer because you are not joining me. Had this been the case that you are leaving that person and joining me, the compensation would have come in your salary head. But that is not the case. So this falls in this particular scenario where it will be taxed under the head other sources. So if I'm paying you compensation, let us say 5 crores, asking you only to do one thing, leave that person's job. Now, when such type of compensation is paid, it is in relation to loss of employment, termination of employment, and it is not paid by your present or past or future employer. I'm never going to be your employer. In such cases, it will be other sources. So this point has a linkage with salary chapter directly, that if paid by employer, maybe future employer, present employer, it is other salary chapter. If paid by any other person, it will be other sources chapter. Fine, students, we'll do one thing. We'll go for a break now because again, this topic is a lengthy topic. We come back after the break. We study this. Fine. Okay. So 15 minutes break, students. which are taxed under other sources. Now there are two important changes. Why I'm calling it as changes? Because originally these were not part of other sources. Later on they have been added. One is a previous point, that is gift. I'll come back to it, but since we have this on screen, I'll start with this first. Now what is this sum? It is the amount which you have received against your life insurance policy. Now this is interesting. Traditionally, whatever you received under life insurance policy has always been exempt under section 1010D. But now the thought process has changed. Firstly, let me tell you that originally life insurance was one of the most tax planning, tax saving tools. How? We first take a life insurance policy where for 15, 20, 25 years, we keep paying the premium. Sorry. This premium was allowed as deduction under Chapter 6A. In fact, it is allowed even today, but under the new scheme, it is not allowed. But under Chapter 6A, Section 80C, you get deduction of the premium. Then the second side was that whenever this policy will mature, or if because of unexpected death, the amount is paid, in whatever scenario it is paid, it would be exempt under 1010D. So both sides you are having benefit. First, at the time of deposit, where you are paying or depositing the premium. Then second, at the time of withdrawal, when you are getting the policy amount. Now this I'm talking about some around 10 years back. Then there was a slight change. They said that whatever premium you are depositing, we will not give you full deduction. They came up with some percentage that your premium should not exceed 20% of the policy amount. If premium exceeds 20% of policy amount, we will give you deduction only up to 20%. This was further amended and it said from 1st April 2012 that the premium should not exceed 10%. If it exceeds 10%, then whatever is beyond 10% will not be allowed as deduction. This was all relating to the first part, that is every year when you are paying the insurance premium. Now, they also brought a parallel amendment in 1010D, which deals with the second part, which is the withdrawal on the maturity or on the death, where it said that whenever the policy is maturing, if the insurance policy premium was within this limits, which I just explained earlier, 20% than 10%, then this amount would be exempt here. If the premium exceeded the 10% or 20%, here also you were not given full deduction. Here also 1010D said it would be taxable. Now that is what is the position, what we are studying now. What is said, sum received including amount allocated by way of bonus under a life insurance policy other than the ULIP plan or the Keyman insurance because they have a separate tax treatment and which is not exempt under 1010D. And I just explained what is the present position. What is exempt under 1010D is those policies where the premiums paid were below these specified percentages of 20% or 10%, depending upon when the policy was taken. Such policies where the premium was within 10%, 20% remained exempt under 1010D. But those policies whose premium exceeded this 10%, 20% are now taxable and they would be taxed under other sources. That is what is the point we are understanding. So see, Here it is. So firstly, before 2003, there was no percentage. So whatever amount you received under life insurance policy, it was always exempt. So nothing was taxed. Under other sources, it was fully exempt. Then between this period, 2003 to 31st March 2012, they brought this 20% criteria. That is, your premium should not exceed 20% of your policy amount. They are using the word capital sum assured. I am using the simple term policy amount. If your premium exceeded 20% of capital amount in any of the years during which the policy is running, then the exemption under 1010D was not available. And the moment it is not available, your policy is taxed under this section 56(2). Then came the period beyond 2012. Now, this period beyond 2012 till date is saying that the premium should not exceed 10% of your policy amount in any of the years during which the policy is running. If it exceeds 10%, then exemption will not be available. Now you'll say, sir, you are saying 2012 till date, but it is saying only 2013. No, till date, the same rule applies. The only difference is that what changed in 2013 is that where a person is suffering from severe disability or regular disability, which is covered under Section 80U, or is suffering from one of those diseases which is mentioned in 80DDB, for such persons only, the 10% has been raised to 15%. But for all other persons, other than this disability or disease covered under 80U or 80DDB, for all other persons, that is for all regular persons, the percentage still remains 10%. So you can keep it in mind like this. From 2012, the percentage is 10%, and only for persons with diseases or disability, it is 15%. Now, a new aspect came in 2023. So one is policies taken before 2012, 20% was the limit. After 2012 till date, 10% is the limit. Now you understand this first, that if your policy premium exceeds 20% or 10%, whenever you are receiving the policy amount on maturity, it will be taxed under other sources. Now comes the period which is 3 years back, that is 1st April 2023. What it says, any sum which is received under life insurance policy is exempt, fine. So the basic rule. However, exemption is not available if the premium in any of the years has exceeded the 10-15% limit that you already know, 10 for regular, 15 for people with disability or specified disease. And now what is added from 2023 is this. Exemption is not available if, now they have also kept, firstly there was only percentage limit, now they have kept the amount limit also. If the premium exceeds rupees 5 lakhs, I'm sure you would have studied this exemption when you are studying the topic of exemption, that is incomes which do not form part of total income, that is section 10. But since it is specifically related to this head, we are studying this again in detail. So now what is the position? That now you have two conditions. The premium in percentage should not exceed 10% of the policy amount, and in amount should not exceed rupees 5 lakhs in any of the periods during the life policy term. Interestingly, what it further says, in case where premium is payable by a person for more than one policy. Now what people did, people found out a way for this. They broke their policy into multiple policies. Then the law even covered this scenario. It said that where you are making payment of premium for more than one policy, then what we will see is the aggregate premium. If that also exceeds 5 lakhs in any of the years, then exemption will be available in respect of any one of those policies which is at option of the assessees whose premium does not exceed 5 lakhs. So let us say you have two policies. One policy's premium is 3 lakhs, another policy's premium is 2.5 lakhs. So individually, none of them is exceeding 5 lakhs. But because of this aggregate criteria, when you add both these policies premium, it is exceeding 5 lakhs. Now, whenever these policy will mature, you will be given a choice that out of both, we will tax one because exemption will be available. See what is given? Exemption would be available in respect of any of those policies which is at your option whose premium does not exceed 5 lakhs. So we will only exempt one of them. The other one would be taxed. So this is what is the present position. Now, most important, all these percentage and amount limits applies only when you are getting the policy amount on maturity. But there is second possibility. What is that second possibility? You are receiving this policy amount because of death of the person. In such cases, the policy remains exempt always. That is, this 10, 15, 20, 5 lakhs, nothing is important. So, premium below 10%, 20%, below 5 lakhs, all these conditions will affect if it is given in the question, the policy amount is received on maturity. But if in the sum it is given, policy amount is received on death, everything is exempt. I hope this is clear. Now coming to the next part, exemption is also not available where the policy was taken for the person who is suffering with disability under 80DD. So under 80DD, you are taking policy for your related person like your brother, sister, mother, father, spouse, children who are dependent on you and who are suffering from disability. Now, in this case, what they are saying that in this particular scenario, if the person in whose name you have taken the policy, if he dies before you, so the law says, uses the word, if that person who is disabled for whom the policy was taken, so the dependent disabled person for whom the policy is taken, and that person dies. Pre-disease, disease means die, pre means before you. So if the person dies before you, now what will happen? The policy amount will come to you because that person has died. The amount which is received will be taxed. And the exemption under 1010D will not apply. Similarly, if the policy is a keyman insurance policy, exemption is not available in any scenario. So these are the two exceptions you can say for the above rule where 10%, 15, 28% and 5 lakhs conditions were given. Or you can say there are three exceptions to that. One, when the policy is received on death, exemption is always applicable. Keyman, always taxable. Policy taken for disabled person and the disabled person dies before you, always taxable, right? Now comes this important circular. What does this circular says? Now it says that 1010D has given exemption where the policy amount does not exceed the specified percentage. Now, what are the different pointers covered here? In case where you have only one life insurance policy, then what is the rule? This exemption would not be available with respect of the life insurance policy issued after this date and the premium exceeds 5 lakhs, right? This we know. Main clarification is where you have multiple policies. Now what I explained just above, that let us say there are two policies. Individually, the premium is below 5 lakhs, but the aggregate premium exceeds 5 lakhs in any one of the years. It is not necessary that it should exceed in all the years. Even if it exceeds in any one of the years during the term of the policy, then what will happen? Then whenever this policy will mature, you are given an option. What is the option? That out of all these policies, the policies whose individual premium is not exceeding 5 lakhs, you can take exemption for that policy. However, to get exemption under this section, the condition of annual premium not exceeding 10% also has to be satisfied, that we know. So this point I have already explained above with the help of that example of 3 lakhs and 2.5 lakhs premium. So whenever you have multiple policies, individual premium is below 5, but aggregate exceeds 5, at the time of maturity, you are having a choice which one to exempt. You can exempt one, the others would be taxed. Second, you already saw in case of death, none of the above conditions apply. It will always be available. What is always available? Exemption, irrespective of 10% or 5 lakhs criteria. Fine. So this is the entire provision, students. I hope you have understood this amount. Right? Is this clear to all? Anybody having any questions? So they have given some practical examples to explain all the above scenarios of multiple policies, single policies, where some policy exceeding 5 lakhs, where no policy exceeding 5 lakhs. So all these are explained here. Right? Kindly go through them for better understanding. We have covered everything in our discussion. But as I've been saying, more than theory, when you look at a sum from the practical perspective, it is more clear. Now, there is some clarification about the GST component. Anyways, from 22nd of September 2025, that is recently. Now, GST will not be applicable on these policies, but for earlier periods, GST was applicable. Now, what is the interesting point? The interesting point is CBDT clarified that the premium which is payable or the aggregate premium, you have to check the 5 lakhs criteria. The question is, when you are checking the 5 lakhs criteria, whether GST added premium should be taken or premium without GST to be taken. Because see, there can be a difference. Before GST, the premium is 4,80,000. But after adding 18%, it crosses 5 lakhs. Then what? So they have clarified, very important. While checking the 5 lakhs limit, you have to check the premium, which is before GST. Okay. I'll take up some questions. Mustafa, it is heavy to process, but something is understand. Yes, but I see, that is the beauty of this subject. And I always say, if these things becomes easy, you will be out of the market. Why are we having demand? Because we are supercomputers. Why we are supercomputers? Because we are keeping so many things in mind. At the same time, we are keeping amendments in mind. At the same time, we are applying different subjects. So that is not possible. Even if you ask questions to this, so recently trending AI tools, they will also not be able to give you correct answers. And that is where you have existence or demand in market. The day when the AI tools will be able to answer all things correctly, people will not come to you, right? Like today, what has happened? Post this AI, many basic medical related questions are being answered by AI. So for the regular checkups which people were going, they have shifted to AI, which I believe is very dangerous. But fine, that is how people think and behave. So keep this in mind that these things are difficult. That is what is good. I always say that whenever you find things which are complicated, confusing, you should be happy, right? Because I know you're not complaining. I'm just informing. I'm just discussing, taking your point as the basis. Another clarification with respect to premium on the term life insurance. Right now, what is term life? See, life insurance policies are of two types. One is called as endowment policy. One is called as term policy. Term policy will make payment only when the death happens, whereas endowment will make payment either if there is death or even if there is maturity. This is the difference. Now the question is, what if your life insurance policy is a policy which makes payment only at the time of death? Now in this case, what will happen? See, so CBDT has clarified that the limit of 5 lakhs of amount of premium would not be applicable in case life insurance policy is a term life insurance policy. Why? Because we already saw above, if any amount is received on death, it is anyways exempt. So any sum received under term life insurance policy will always be exempt. So term policy, you don't have to see any limit. So simply because this policy is such that it is anyways going to make payment only if death happens, so it is going to remain exempt. Now coming to the next part, taxability. So once you've decided which policy will be exempt, which will be taxed, now coming to the question of how it will be taxed. So what it is saying, where any sum is received, and this is always using the word including amount which is allocated by way of bonus, because many times the policies are with bonus policies. So you receive either only the basic amount of policy or with bonus. For both cases, what it says, what will be taxed is the amount which is not exempt under 1010D. So other policies which are exempt anyways, that cannot be taxed. Now comes the main important point. How much amount is taxed? So if I can write here, taxable amount is equal to whatever amount is received. So I use the word policy amount received minus what? Aggregate of the premiums paid. See, this is logical. So over, let us say 20 years, which is the policy period, you have been paying every year 1 lakh as premium. So over this policy period, you have paid 20 lakhs as premium. Now, what will be taxed today is, let us say on maturity, you are receiving 27 lakhs, which includes the policy plus bonus. So 7 lakhs would be taxed, right? But what is the condition? Which is not exempt, the sum so received as exceeds the aggregate premium during the term of such policy, and most important, not claimed as deduction any under provision. So this premium, which is not claimed as deduction under any other provisions. Now, what are the other provisions? Mainly it is section 80C, that is chapter 6A. So if you have claimed deduction, then fine, we will not reduce it now. But if, let us say, for some reason you did not claim deduction of this premium paid, then only it will be subtracted, and the difference will be taxed under other sources. Now, there is a specific rule which deals with this computation, rule 11 UACA, which deals with what? How to compute the income which is chargeable under this particular section. So what it says, where any person received at any time during the previous year any sum under such LIP, then the income chargeable to tax during the previous year in which the sum is received has to be computed in following manner. Now, what is the following manner? It is simple. It is A minus B. What is A minus B? A is the sum or aggregate sum which you have received. So I'm calling it as policy amount for simplicity. And what is B? B is the premium which you have paid, aggregate. So in all the years, whatever premium which you have paid and which has not been claimed as deduction. So the premium which is not taken as deduction. Now, what is the second part? Second part is, or rather, let me first explain first part, where this sum is received for the first time. Now see, there are certain policies which will make payment only once, that is at the end. But now insurance companies have come up with different plans. Like let us say my policies of 15 years, they will pay me after every 5 years. So 5th year, 10th year, and then finally on maturity. Now in such cases, every time you are receiving some amount. How to compute this? So where the sum is received in a subsequent year. So first year when it is received, that is in the 5th year, you do A minus B. When it is received in the 10th and the 15th year, that is after the first year, you do C minus D. Now what is C? C is the sum or aggregate of sum received under the LIP. So again, it is the amount received. But you have to subtract D. Now, just be slightly logical. If you look at this logically, you need not learn this. What is D? It is again the aggregate of premium. Again, this aggregate of premium will be the one for which you have not claimed deduction. And also, which is included in B or D, means the premium which was already deducted earlier. So means what? See, logically, what you would have done here, A is the amount received minus B is the premium that you have paid till this date. Now, when you are doing computation of this, you have again received some amount, which they are calling it as C, minus whatever premium you have paid from here to here. Not this premium. Why? Because this premium is already deducted here. So what should be deducted in D is only this premium. Similarly, again, you will receive it for the third time. Again, the formula is C minus D. C is the amount received every time. And D is again only this premium. So whatever premium you have deducted earlier, obviously that should not be again deducted. So that is the simple logical point. I'm sure you all understood this. Yes, students. So see, when you only read A minus B, C minus D, it appears to be like reading some scientific formula. But here, whatever we are writing as a formula is plain logic, simple logic. I hope this A minus B and C minus D is clear to everyone. Right, students? Then here they have covered the list where income will be chargeable under this head only if it is not chargeable under PGBP. What are those incomes? Now this is where you are receiving the employee's contribution. So whenever you deduct the employee's contribution for Provident Fund, if you remember PGBP, first when you deduct, it is covered as income under 28. Here it is covered income under 56. And then you have a deduction also. So minus, what is the deduction? Deduction is this same Provident Fund contribution which is deposited within due date of respective act. If you remember, the same was deduction even in PGBP. So when you deduct the premium deducted is firstly treated as income under PGBP and here under other sources. And then if this premium is deposited within the time limit, which time limit? Not time limit of filing returns, but time limit under the Provident Fund Act or the ESI Act, then the amount of this Provident Fund or ESI contribution deposited within the due date of respective act can be deducted. Second is where you are letting out any plant machinery on hire or where building is also let out with plant machinery on hire. Now here, what is the deduction? Here the deduction is for depreciation, repairs, maintenance, insurance, all such expenses which are incurred on these assets. Again, depreciation will be as per the block method. So here you will deduct the deductions under respective expenses category like depreciation, repairs, maintenance, insurance premium. All these things are deductible. This is what is given in section 58. I'm writing out the respective deductions here itself so that whenever you are studying, you need not go to that section again. Now coming to a very important point, I already discussed today at the start that when this income will go to PGBP, where you are getting interest on trade investments. If that investment, that security is not a trade investment, then it will never come under PGBP. It will always fall here. Now, importantly, there is an exemption under 1015. Now, what is this exemption under 1015? Certain interest received on certain specified investment securities are exempted and hence they will not come under other sources. Now here there is a list. You need not learn the list. You have to keep in mind only 3 words. Wherever you are receiving interest on something which is given as a notified bonds, debentures, etc. Or another word is, now see, I'll just mark the words. So one word is notified. The another word is specified. So wherever they will say that it is on a notified or a specified bonds debentures, you should know that it is exempt. Now here, this one point you will have to learn the limit. What is this? You are receiving interest from a post office saving bank account. Now here, when the interest is received on post office saving bank, then here there is an amount limit where rupees 3,500 is exempt if it is an individual account, and if it is a joint account, then 7,000 is what is exempt. So this is what is the exemption relating to interest. Keyman insurance, we already discussed today also and earlier also, that when it will be covered under PGBP and salary, and when it is not covered under PGBP and salary, that is where it is taxed here under other sources. And then comes a residuary provision. Residuary provision says that where the income is not chargeable under any other head, but firstly it should be your income, and it is not falling under any of the other 4 heads, then it will come under other sources. Now here again there is one exemption under section 10 bracket 70. If you are a member of parliament or state legislature, whatever you get as allowances, that is what is exempt. First point, whatever they get as salary, it is not taxed under salary head. Why? Because they are not in the capacity of employees. They are representatives of public. So whatever they are getting, even though you may call it as their salary, it is chargeable as other sources. And then whatever is the allowances in this, that is exempted under 1070. Now these are the names of the allowances which gets covered. Daily allowance, constituency allowance, these are exempt. Now what are some other exemptions relating to other sources income? For interest, we have an exemption where the interest is arising from an account whose account, NRE account, that is non-resident external account. Now when such an account is opened as per the RBI guidelines and you are depositing money in that account, whatever interest is earned on such money, that interest is exempt. First point. Second, if the compensation is paid by government, why? Because of some disaster. Like if you remember, there are certain situations where because of train accident or something like this, the government pays some compensation, some road major accident, some fire somewhere. So for all these disasters, whatever compensation is paid by the government, it may be a central government, state government, or even a local government, that is what is exempt. However, this exemption is not available in respect of that particular compensation where you have already claimed that loss as deduction. So let us say you are claiming that loss as deduction because your goods have destroyed by that fire, etc. in PGBP head, then compensation is not exempt, it will be taxable. And what will cover under disaster, they have given a definition. It may cover catastrophe or a mishap or a calamity, etc. And which has caused, what has it caused? It has caused substantial loss of life, or it has caused damage, destruction of property, or it has caused damage, degradation of the environment. Next, if you get scholarships. Now, what is very important, the scholarship should be education scholarship, not any other scholarship like for sports or anything else, because you get scholarships even for that. Only for education, where the scholarship is received, it is exempt. What is important is this exemption is irrespective of who is giving the scholarship. Many times we have a wrong understanding that only where the scholarship is received from government, then it will be exempt. No, it may be government or it may be private. So even if any private institution or a trust or a body gives you scholarship, it will remain exempt. Next, where you are given award by the government. Now government announces various awards which are given like on this 26th January or on such days. Some awards are being given. Most important is here again the condition is that these awards should be instituted by the central or the state government. Only then it will be exempt. If it is by any private body, it will not be exempt. Then payment in commuted pension. I'm sure you remember this. This was covered in 1010A, which you studied in salary chapter. What is covered here is where you have taken a policy of insurance where under the policy of insurance you are supposed to receive pension. So we call these policies as pension plan. Now instead of getting lump sum pension, you decided to commute this pension. Now please understand, when you are getting pension from an insurance company is not your employer. So firstly, this pension is not taxed under salary, it is taxed under other sources. Now, if you are commuting this pension, same like under the salary, how you commute and take lump sum pension, here also if you are commuting and taking lump sum pension, they say it will be exempt. So whatever commuted pension you have received from this pension fund, which is set up by LIC of India and obviously which is approved, that will be exempt. Next, exemption for withdrawals from National Savings Scheme. Now for a deposit in National Savings Scheme, you had this particular deduction, which is no more applicable. It has been withdrawn now. But what is covered over here is that whenever depositor who has intended to leave their NSS balance untouched for future and will lose interest benefits and be compelled to withdraw the balances, making these amounts taxable. So ATC has been amended to provide exemption to the withdrawals. So whenever you are withdrawing any amount from the NSS scheme, you will be given this exemption. But again, the same condition for any amount deposited under the scheme and interest accrued thereon in respect of which you have not claimed any deduction. If you have claimed deduction, then there will be a challenge. Next is interest received from non-SLR securities. If you remember, I had mentioned this today when I was explaining trade investments, that banks have to compulsorily maintain CRR, CLR, SLR, all these as per some fixed ratio given by the RBI. Now, when they are maintaining the SLR, they have to carry some securities. Now, these are their trade investments. But what about those securities which are not falling in SLR? Why? Because SLR, let us say, requires you to maintain 10% in securities, obviously government securities, but you are maintaining 12%. So up to 10%, the securities are SLR securities, but beyond 10%, that is this extra 2% in my example is a non-SLR security. Now the question is whether the interest which you receive from this 2%, whether it is PGBP or it is other sources. Now you remember, I've already explained above that whatever is trade investment, in this case, 10% is a compulsion. You have to compulsorily maintain securities. That interest is PGBP, no doubt, because it is coming from trade investment. But the 2% part, which is over and above the compulsion. So this 2% will be a non-trade investment. And we have already discussed about that non-trade investment will be part of other sources. However, in case of banks, there is slightly a different understanding, which is explained in this circular. What does the circular says? It is issued to address that in case of banks, expenses relatable to investments in non-SLR need to be disallowed under section 57(1) by considering interest on non-SLR as income from other sources. This section provides that income by way of interest on security shall be chargeable to income tax under other sources if the income is not chargeable under PGBP. Now, what the CBDT has clarified? CBDT has clarified that investments which are made by banks are always part of banking business. This is what has been clarified. Therefore, income which arises from such investments is to be treated as PGBP always. So, the point that trade investments will be PGBP, non-trade investments will be other sources has this small exception, you can say so, right? Now, what are the applicable tax rates? If your income is by way of winnings, but other than online gaming, because for online gaming, we have a different rule. For all other winnings, what is the tax rate? The tax rate is 30% plus surcharge whenever you cross the surcharge applicability limit, plus 4% health and education cess, right? Most important, there is no deduction allowed. So you cannot claim any deduction, whether for of expenses or of any allowance. No deduction can be claimed. Similarly, Chapter 6A deduction is also not allowed. Further, basic exemption limit also cannot be adjusted. So in short, as I mentioned above, these winnings are taxable gross. Now, we come to the new section which was introduced in 2022, that is for taxing your winnings from online games. Now, what is important in relation to online games is, please understand this. Whenever you have to play an online game, the methodology is you create a wallet. In wallet, let us say you deposit 10,000 rupees. Now, when you want to play a game, that game requires 2,000 rupees as the fees, whatever fees you can call it, the entry fee or the fee for playing the game, etc. Now you transfer from this wallet or you utilize from this wallet 2,000 for a particular game. For another game, let us say you utilize 3,000. Now this game you lose, so you don't get anything. This game you win, so you get 15,000. Now interestingly, what has happened? This amount and this amount is debited, so reduced, but 15K is added. Now, interestingly, your wallet will keep on having plus minus, plus minus, plus minus. Minus when you utilize the amount, plus if you win anything and it comes to your wallet. So first understand the working methodology of the wallet that you are using in case of online games. Now, how this will be taxed? Tax rate is simple. It is 30%. Plus again the 4% says everything is okay. The only point is this word. Here, if you see above, here the word was not net winnings. It was only winnings, and I already mentioned this is gross. Gross means without allowing any deduction. However, here the word is net winnings. But interestingly, here also no deduction is allowed for expenses. No deduction under Chapter 6A is allowed. Also, the basic exemption limit cannot be adjusted. So the same restriction is there like above. But then what is this net? So net means when you are using a wallet, there will be continuously debit, credit. So net means when you will be withdrawing from the wallet, you will be taxed only on the net amount. How this net is to be calculated, that is explained further. But what you need to remember is, in case of online gaming, the law says that we will tax you on the net. So basically, it is net of this amount which is kept as deposit. So over and above the amount of deposit, whatever you are getting, because the deposit is your own money, which you have kept in the wallet. So that is how what they mean to say net is, but that you will understand in detail when you discuss that point. For the time being, what is given meaning of online gaming? What meaning is given? It is a game which you play on the internet and it is accessible by a user through a computer resource, including a telecom device. So wherever you are playing a game on internet. Now, what is opposite to online game? Opposite to online games are those games which you are playing on a downloaded basis and which is not played live. So we already play many games which are downloaded in our phones or maybe in our laptops. That will not be online. Now, what are the deductions allowable? For dividends, we already discussed. We also discussed today interest on securities. There is nothing specific given. It says only any reasonable sum paid by way of commission. Now, this point means many times these interests are coming to your bank and the bank is debiting some charges for realizing this interest. So those bank charges are deductible. This point I already explained. Firstly, when you deduct the employee's contribution, firstly, it becomes your income. Then later on, when you deposit this contribution, but when before the due date under the respective act, only that is what is allowed as deduction. And this point is similar to the PGBP point under section 36(1)(5)(a). So both the points are similar, that firstly, when you deduct the employee's contribution from their salary, it is firstly your income, either PGBP or other sources. And then when you deposit this contribution, employee's contribution to the respective fund, that is Provident Fund, ESIC Fund, Gratuity Fund, as per the due dates given under the respective acts, then only you get deduction both under PGBP also and under other sources also. Now it says online money gaming is prohibited. See, I'll tell you one thing, right? Online money gaming is prohibited. Then this taxation should not be there. However, I'll not say what you are saying is completely wrong. See, there is something which is still pending with the Honorable Supreme Court is the taxability of betting and gambling. Now, importantly, many states, because betting gambling comes under the state domain. So many states like Karnataka and many more states, I'm not now not recalling, but I remember Karnataka because the case that we have has originated from there. So many of these states had made a strict laws in their states that they prohibit gambling and betting. Now, when these online gaming started, the main question that has to be answered is that what these games are doing, whether it is betting gambling or it is a skill. Because see, when you say game and you play a game, it is a skill. We call it as game of skill. So the present debate, the present challenge which is going on is whether online games are a game of skill or game of chance. Till date, multiple high courts, and if I'm not wrong, even in one honorable Supreme Court decision, they have said that irrespective of how you play it, even though you use your skill or not, these would be considered as game of chance. First point. However, I believe still the battle is long. We are yet to get the final verdict on this. But what you are saying is right. But the second part, whether or not these games are prohibited, interestingly, keep this in mind, students. Income tax has nothing to do with the legality. So where your source is illegal, so prohibited means now it becomes illegal. The government has nothing to do with that. The government says, even where your source is illegal, if that income falls in our taxation scheme, you have to still pay the tax. So even if, let us say, this online gaming becomes prohibited or illegal, it will be taxed. Mustafa says, if we win 1 lakh on winning lottery and you won again, the lottery, both are taxable, ticket purchase, not deductible. Correct. Now 115 JB is if you start a wallet 15K, you deposit, then you win 10K, then lose 20K, then win 5K. So last 10K is taxable. No, but wait, Mustafa, when we go to that section in detail, you'll understand what I mean by what I said, right? Next, what is the deduction when you are getting income from giving things on hire? I already wrote that above when we were dealing with this income. You get deduction for repairs, you get deduction for insurance, and you also get deduction for depreciation. So all these expenses, and this is parallel to what you study in PGBP also. Now coming to something which we did not read in the above list, in the income list, that if you are receiving a family pension. Now firstly, let us understand what is a family pension. So let us say I'm an employee in a company or in any organization. After my retirement, that organization is paying me pension. When I receive it, that is the employee itself receives it, you call it as pension. It is taxed in the hands of the employee under the head salary. However, if after the death of the employee, the pension is still continuing with the wife or the children or the parents, we call it as family pension. Now, pension received by employees taxed under the head salary of the employee. But after the death of employee, whatever pension is coming to the family members, it will always be income from other sources. So first point, family pension covered under income from other sources. So first thing is clear about the head. Now comes the point. What is the point? What is the deduction? The deduction is 33 1/3%, or simply you can say 1/3. So whatever is the pension received, take or make 1/3 of the family pension. So whatever is the pension amount, take 1/3 of this and compare it with 15,000, whichever is lower, because 15 is the maximum limit. So 1/3 amount, compare it with 50,000, whichever is lower, is your standard deduction. Now here, interestingly, there are two limits. If you are in the new scheme, the limit is 25,000. Otherwise, it is 15,000. Now, there are few exemptions for family pension, where the family pension is received by members of armed forces, that is their widow, children, etc. And the death of this particular person has occurred during their operational duties or because of injuries sustained in the operational duty. So members of armed forces, let us say the person has gone for a war or in a terrorist attack situation, and there the armed forces person expired, passed away, or sustained certain injuries, and at the time of treatment the person passed away. So that particular person's pension, when received by the family members, is fully exempt. Further, pension and family pension received by those persons to whom government has awarded one of these gallantry awards. So these are all gallantry awards: Paramveer Chakra, Mahavir Chakra, or the Veer Chakra. So the person who has received these awards, that person himself, herself, or their family members, when they receive pension, that is exempt. So in two cases, family pension is exempt. Then comes the general deduction, saying like section 37 of PGBP. Besides the above specific deduction, even if there is any other expenses which is not of capital nature and which is for the purpose of earning this income, which is covered under other sources, this will be allowed as deduction. This is similar to section 37 of PGBP. In 37 also you had general deduction. And then this 50% we have already discussed. In case of interest which you receive on compensation or enhanced compensation, which is taxed in the year of receipt, you will deduct 50% and you will tax only the balance 50%. So these are the deductions. And then you have the disallowances. Firstly, what is disallowed? Personal expenses. Then interest paid outside India, salary paid outside India, on which TDS is not deducted. So these are disallowed full. Then where the payment is to be made either to a resident and the payment is to be made in India, if the TDS either has not been deducted or after deduction has not been deposited before the due date of filing returns, we have studied that 30% of the expenses disallowed. Then payment is made to related or specified persons. In such cases, if the payment made to related or specified person is made over and above the FMV, then the excessive or the unreasonable portion will be disallowed. And secondly, where the payment is made in a day exceeding 10,000 to a person, otherwise than by way of account pay, check, draft, etc., the whole amount will be disallowed, and this 10,000 is 35,000 in case of freight payments. So all these are straightforward, similar points as what we have studied under PGBP. Last point is no deduction in respect of expenses incurred in connection with casual income. So against winnings, we already studied above, no deduction is allowed. Winnings would be taxed fully. The winnings would be taxed gross. So against the winnings, nothing would be allowed as deduction. Deemed income, this is similar to section 41 of PGBP. Now, what was 41, students, in PGBP? So PGBP section 41 said that if you have claimed deduction of any expense or loss in the past, and in the current year, that past year's expenditure or loss is reimbursed, recovered, like recovery of bad debts. So if you have claimed deduction of that expenses in the past and it is recovered in the current period, that amount will be deemed to be your income under section 41 of PGBP. Same thing is deemed here under section 59 of other sources, right? So we stop over here. We have again one more class tomorrow. So tomorrow we cover that one point, that is relating to gift. We will go and study if something is left out here or if something is a doubt. And if time permits, I will cover the presumptive income part of PGBP, which I had kept aside in the PGBP chapter for paucity of time, but I had said that we will cover it in our future chapter. So tomorrow we will cover the remaining part, which is only one part left here, and this point from PGBP that we have kept aside. So with this, I conclude today's session. Thank you, students. Thank you very, very much. Please read the whole chapter today so that tomorrow you are ready with your queries, your doubts, if any. Fine. Thank you all. Thank you very much. And yes, better notes will be uploaded, Dhanalakshmi. Please bear with me. I'll definitely upload the capital gain notes. I did not upload it because of that confusion of 36 months, which yesterday only I confirmed. In fact, let me tell you, I am still waiting because I had a different plan. I thought that I'll upload it after 1st Feb to see if amendment comes or not. But then I'll do one thing. I'll upload it by keeping that point blank in the slum sale part. So after this 1st Feb, that is the budget day, if by chance that amendment comes and we make it applicable to your exams, then you can by hand make the additions over there. Fine. So yes, thank you all. Happy Lohri, happy Makar Sankranti, and also enjoy the festival. I'm not saying don't enjoy, but at the same time, please ensure that you will cover this whole chapter today with all the practical examples in between of every topic and at the end, so that tomorrow we complete this whole topic fully. Thank you all. Thank you very, very much. Good day. Yes, Ashok ji. Thank you, sir.